And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down.
Expanding Canada's oil and gas infrastructure has long been a contentious topic, but tough tariffs have forced the country to take a closer look at its sovereignty and self-reliance on its own resources.
U.S. oil prices have plunged, exports are stalling, and what was once Washington's trump card is now on the edge of collapse. Some say exports could drop by 88% almost overnight. From the ports to the Permian Basin, the slowdown is clear. Shale producers are pulling back, output is falling, and jobs are disappearing in states once booming with oil money. The home market can't soak up the extra supply. So what's next for an industry once seen as the backbone of America's economy? Who really controls the global energy game now? And is power quietly shifting away from the U.S.? Is this only about prices? Or are hidden policies forcing U.S. oil to its knees? Let's break down this dramatic crash, because what's happening now could rewrite the world's energy map. When the U.S. slapped new tariffs on crude oil from Venezuela, the goal was to squeeze a South American regime, but the ripple effects went global. Within weeks, oil markets were in chaos. Prices tanked an estimated 94%, a drop almost no one saw coming. And this wasn't just supply and demand. It was panic spreading through energy exchanges in Asia, Europe, and North America. Investor fear drove massive sell-offs. Trading floors were flooded in red. In Texas, New Mexico, and Louisiana, oil prices sank below the cost of pumping it out of the ground. Wells that once made fortunes now bleed money. Rigs have gone quiet. Layoffs are hitting hard. Small energy companies are folding or dumping assets just to stay afloat. Some say this is a needed correction. Others warn local economies could be crippled for years. The futures market, once the shield for producers and investors, is on shaky ground as tariff surprises keep everyone guessing. Liquidity for WTI and Brent contracts has dried up. Risk management? Good luck, especially for smaller drillers with thin wallets. With Venezuela's oil out of the picture, big importers like China, India, and Turkey are scrambling for new suppliers. U.S. oil is high quality, but the price swings and policy risks scare off buyers. Some have turned to Iran or shady middlemen to keep oil flowing from blocked regions. The big question, is U.S. crude still seen as reliable? Not long ago, America was the world's top oil exporter. Today, that crown looks shaky. Major energy blocks in the Middle East and Asia are adjusting without the U.S. at the center. Some think this crisis will pass. But if it drags on, America's role in global energy could be permanently reshaped. For U.S. oil, the numbers say it all. WTI crude is now under $60 a barrel, below the $60 to $65 break-even for most shale producers. Not long ago, prices hovered above $70 or even $100. That margin paid for drilling, workers, tech upgrades, growth. Below $60? Many can't cover costs, especially smaller firms already squeezed by tight credit. So where does this leave the American oil dream? And who stands to win as the world rewrites the energy rules? Stay tuned, because this story is far from over. When oil prices crash, entire towns can fall with them. What's happening in America's shale oil fields right now isn't just about money. It's a storm shaking communities, jobs, and even global politics. Operating below break-even feels like swimming through a hurricane with no shore in sight. Many shale oil companies are cutting output or shutting wells altogether because current prices can't cover basic costs. In key states like Texas, North Dakota, New Mexico, and Oklahoma, once the backbone of shale oil, expansion plans are frozen, drilling contracts scrapped, and rigs pulled from the ground. And it's not just the drillers. Contractors, service crews, and trucking companies tied to the oil supply chain are feeling the pain too. Industry reports say thousands of oil and gas workers have lost their jobs in just weeks. Big service giants like Halliburton and Schlumberger are also taking hits. Small towns that rely almost entirely on drilling are already slipping into local recessions, with families facing hardships they haven't seen in years. At the massive Cushing, Oklahoma hub, America's oil bottleneck, storage tanks are nearly full. Offshore, Tankers sit idle for weeks because no one wants the extra supply. This glut keeps prices low, storage maxed out, and the market stuck in a vicious cycle. Energy stocks reflect the chaos. Major players like ExxonMobil, Chevron, and ConocoPhillips have seen their share prices drop fast. Investors who once counted on energy for steady returns are pulling their money to dodge short-term risk. The S&P 500 Energy Index has taken its biggest dive in years, shrinking cash flow and making it harder for companies to borrow what they need to survive. Experts warn that small and mid-sized producers, especially those deep in debt, are at high risk of default. Cheap oil plus rising borrowing costs are shaking confidence in the entire shale business model. The U.S. energy sector is known for bouncing back, but this time, unpredictable policies and a shaky global market make the road ahead far less certain. Then came the big twist. On April 9, 2025, after days of chaos, the U.S. government suddenly paused tariffs on most oil-exporting nations for 90 days, except China. Many say this was just a band-aid to calm markets and stop a full-blown oil crisis. Brent and WTI prices jumped about 5 to 7% in 2 days, giving some hope, but still far below the $70 plus seen earlier this year. For drivers, cheap oil means filling up your truck in Texas now costs $80 instead of $100. But for producers, every barrel sold still doesn't cover costs. Instead of boosting output, many companies are slashing staff, delaying drilling, or shifting to wind, solar, or natural gas. This small price bump is mostly psychological, a technical bounce as traders call it, because the core problems haven't gone anywhere. Global oversupply, weak demand, and policy whiplash. U.S. producers are still hesitant to drill more when tariffs could snap back overnight. China, meanwhile, is retaliating against high U.S. tariffs by cutting crude imports, threatening a huge market for American oil. Some worry this will spark even more geopolitical tension and scare off investors in energy funds and futures. Unless the U.S. finds smarter policies and stronger global cooperation, experts say the energy sector could face even bigger hurdles ahead. What started as small cracks in the oil market have now grown into deep fault lines where trade wars, policy shifts, and financial stress collide, making the future of American energy more unpredictable than ever. What started with tensions in hotspots like Venezuela and new U.S. export restrictions quickly spread into a far bigger storm. Within weeks, major economies jumped in, turning a few trade spats into a complex power play reshaping global energy markets. China, one of the world's biggest energy consumers, hit back at U.S. tariffs with import taxes of up to 125% on American crude oil and LNG. A bold move that hints at a long-term shift in how energy flows around the globe. At the same time, Beijing is filling its oil reserves and boosting imports from Iran, Russia, and parts of Africa, strengthening its energy security and cutting reliance on markets vulnerable to U.S. policy twists. Behind the scenes, these shifts are shaking up the balance of global supply and demand. OPEC Plus members, led by Gulf producers, are pushing a prolonged low-price strategy, putting fresh pressure on the already struggling U.S. shale industry. For American shale producers, rising financing costs, hedging challenges, and shrinking derivative market support are piling up, and OPEC's pricing game isn't helping. Financial markets are feeling the heat too. Trading volumes for futures and options on the Intercontinental Exchange hit over 219 million contracts in Q2 2025, a record high. On the surface, that looks like healthy activity, but many experts believe it's investors scrambling for cover, locking in prices to guard against unpredictable shocks. The bigger picture looks even tougher. The International Energy Agency says global oil consumption in Q2 2025 could be the lowest since COVID. This isn't just another dip. It's being driven by sticky trade barriers, rising tariffs, and soaring input costs that are dragging down global industrial output. Agriculture, a major fuel consumer for machinery and transport, is also hurting. Lower production and processing shutdowns are cutting diesel demand, while port backlogs, container shortages, and soaring freight rates delay shipments. Businesses and consumers alike are tightening spending and travel. International flights are down sharply, and freight activity by road and sea is slowing as orders drop and fuel costs climb. As a result, new investments are being delayed, projects shelved, and support industries like drilling, transport, and equipment manufacturing are taking big hits. Many companies are cutting jobs, consolidating, or shutting down offices, rippling through the job market and dampening both business confidence and consumer sentiment. Institutional investors in energy and infrastructure are growing more cautious by the day, a sign that the energy world's next chapter might be even more unpredictable than the last. This was just the beginning. Hit that subscribe button and buckle up. Digital Garage has so much more in store.